Chapter 23, we're gonna do flexible budget performance report. Now, we have actual results, we have flexible budget, and we have static budget. Now, these two are budgeted numbers, but for the flexible budget, we prepare budgets at more than one activity level. So, I prepare a budget, for example, if I sell 8,000 units, 10,000 units, and 12,000 units. While for the static budget, it's prepared only at one activity level. So it's going to be prepared if I sell 10,000 units, for example. So I'm going to take actual results, which will be available at the end of the year. And I'm going to take flexible budget, which is the budget at the actual number of units sold, and static budget at expected number of units sold. Now, the difference between actual and flexible, we call it flexible budget variance. The difference between flexible and static will be sales volume variance, and the difference between actual and static, we call it static budget variance. So variance means the difference. Now we have this question. XYZ company has prepared a static budget at the beginning of the month. See, it's at the beginning of the month. That's why it's budgeted. I don't know the actual numbers at the beginning of the period. So this is the static budget data. So all of this will be budgeted. All of this will be estimated. At the end of the month, the following information has been retrieved from the records. So this is the actual results. These are actual numbers, okay, and these are the budgeted numbers, okay. So flexible budget performance report will look like this. We're gonna have three main columns, which is actual results, flexible budget, and static budget. Then we're gonna find the variances, flexible budget variance and sales volume variance. So for the actual results, I need to multiply actual quantity times actual price. For the flexible budget, I need to multiply actual quantity by budgeted price. For the static budget, I need to multiply budgeted quantity by budgeted price. So let's see for the units sold now. I need actual quantity, so I'm gonna look at the actual results, which is 990 units. For the flexible budget, I also need actual quantity, so I'm gonna use the same number, which is 990. While for the static budget, I need budgeted quantity, so I'm gonna look at the budgeted numbers, which is 1,000. So now for the sales revenue, I need to multiply actual quantity, which is 990, by the actual price, which is 74. Now for the variable expenses, I need to multiply 990, which is actual quantity, by the actual variable expense per unit, which is 35. Now sales less variable cost equals contribution margin. So 73 to 60 less 34 650 equals 38 610. Now for the fixed expenses, I need actual quantity multiplied by actual price. As you know, the fixed cost is constant as total regardless of the number of units. So you need to look at the price. Is it actual or budgeted? So here it's actual price, so you need to take the actual fixed costs, which is 33,000. Now, contribution margin less fixed expense equals operating income or loss. So 38,610 less 33,000 equals 5,610. Now let's do the flexible budget column. It's actual quantity multiplied by budgeted price. So actual quantity is 990 units. I need to multiply it by the budgeted price. So for the sales, I'm gonna multiply 990 by the budgeted price, which is $70. Now for the variable expense, I need to multiply actual quantity, which is 990, by the budgeted variable expense, which is 32 per unit. Now for the contribution margin, it's sales less variable cost. Now for the fixed expenses, again, fixed expenses are constant as total regardless of the quantity. So I need to look at the price part. I need budgeted price, so I'm gonna take the budgeted fixed expenses, not the actual one. So it's gonna be 37,500. Now operating income or loss is gonna be contribution margin less fixed expenses. Now let's go to the last column, which is static budget. I need budgeted quantity multiplied by budgeted price. So I'm gonna look at the static budget data, okay? So I need to multiply 1,000 by the budgeted price, which is 70 for the sales. For the variable expenses, I need to multiply 1,000 with 32. And contribution margin, it's sales less variable cost, so 70 less 32. Now for the fixed expenses, here I need budgeted quantity by budgeted price. Again, fixed expenses are constant in total regardless of the quantity, so I need to look at this part. It's budgeted, so I'm gonna take the budgeted fixed expenses, which is 37,500. Now contribution margin less fixed expenses equals operating income, which is $500. So now we are done with actual results, flexible budget, and static budget columns. Now we need to find the variances. Now let's find flexible budget variance, which is the difference between actual results and flexible budget column. Okay, so 990 less 990, it's gonna be 0. Sales, so 73,260 less 69,300. And I found the differences between each two. Okay, now we're gonna talk about favorable and unfavorable later. Let's do the sales volume variance now, which is the difference between flexible budget and static budget. So 990 less 1,000, it's gonna be 10. For the sales, 70,000 less 69,300. I calculated the rest of them. Okay, so now let's look if it's favorable or unfavorable. Okay, now for the units sold, okay, I expected to sell 990, but I sold 990, so there is no difference, so it's not gonna be favorable or unfavorable. Here, for the sales revenue, I expected to get 69, I get 73. So the actual number was greater than the budgeted one for the sales, so it's gonna be favorable variance. For the variable expense, I expected to pay 31, I paid 34, I paid more, so it's gonna be unfavorable. For the contribution margin, it's a profit. So I expected to get 37, I got 38, so it's gonna be favorable. Now, for the fixed expenses, I expected to pay 37, I paid 33, so it's gonna be favorable, I paid less. Now for the operating income, I expected to get 120, I got 5,610, I got more, so it's gonna be favorable variance. Now let's see the sales volume variance. I expected to sell 1,000, I sold 990, so I sold less, so it's gonna be unfavorable. For the sales, I expected to get 70, I got 69, I got less, so it's gonna be unfavorable variance. Variable expense, I expected to pay 32, I paid 31, I paid less, so it's gonna be favorable variance. Now for the contribution margin, it's a profit. I expected to get 38, I got 37, I got less, so it's gonna be unfavorable. Now for the fixed expenses, there is no difference, so it's gonna be 0. For the operating income, I expected to get 500, I got only 120, I got less, so it's gonna be unfavorable. Now if he asks you about the static variance, it's gonna be the difference between these two. So I expected to get 500, I got 5,610. So it's going to be a favorable variance, and the difference will be what? 5,110. Thank you for watching. If you have any question, please leave a comment. Please like, share, and subscribe.